these interest rate hikes are going to start to kick in. They're long lags. We don't know exactly how long. And so at some point, we are going to see a lot more tensions. It's hard to know. It might not be till 2024. I don't think there's any way to get rid of the inflation that the U.S. has, to get it down from, say, 3 to 4%, and bring it down to 2 or 2.5%. I don't think there's any way to do that without having a recession. And so what I think the Fed's going to do is say, well, we're going to take it slow, and they're going to leave inflation up. And then maybe in that case, there won't be a recession. But it's very hard to know what's going on now. The pandemic has distorted markets, labor markets, supply chains. Half our office buildings in the United States are still empty half the time. It is hard to read for everyone. And so far, the U.S. is surprised on the upside, but that doesn't mean there aren't more surprises ahead that could be in the other direction.
Inflation is often a silent thief that slowly eats away at the value of our hard-earned money. But what happens when this thief decides to come out of hiding and steal in broad daylight? This is the reality that Kenneth Rogoff warns us about, and it's one that we cannot afford to ignore, especially when it resembles the dismal stagflation era of the 70s. The world economy is already under tremendous stress. Therefore, the prospect of entrenched inflation could be the final nail in the coffin for many businesses and households. So, should we heed Rogoff's warning and take action, or will we continue to turn a blind eye to the potential catastrophe that lies ahead? Well, many skeptics believe that Rogoff's prediction is miscalculated and based on poor methodologies, but to know exactly which areas of his prediction they dismantled, stay tuned to Profit Protection to see if Rogoff's track record validates him or not. But to understand if we're heading into yet another stagflation, we should probably brush up on what it was and what it looked like. On a broader scale, stagflation was a combination of high inflation and stagnant economic growth. Fair enough, it's in the name, but this was an unusual phenomenon because inflation was typically associated with economic growth, and attempts to stimulate growth often led to higher inflation. However, in the 1970s, the US economy experienced both inflation and high employment, which led to stagflation. An article from Brookings explains how today's global economy is similar to the 1970s, but emphasizes that governments still have a chance to escape a stagflation episode. It highlights that the similarities between the two periods include a rise in commodity prices, a shift towards more nationalistic economic policies, and increasing inflationary pressures. However, governments can avoid stagflation by implementing sound economic policies such as investing in education and infrastructure, keeping interest rates stable, and avoiding protectionist trade policies. The author of the article also contends that these measures can help governments avoid a potential economic downturn and ensure long-term economic growth. Nevertheless, while the current global economic situation shares similarities with the 1970s, there are also key differences that could potentially prevent stagflation from occurring. One of the main factors that contributed to the stagflation of the 1970s was a supply-side shock that caused both higher inflation and slower economic growth. In contrast, the current situation is largely driven by a demand-side shock caused by the pandemic, which could potentially be addressed with appropriate policy responses. And for the record, a supply-side issue refers to a situation where the ability of producers to supply goods and services to the market is constrained, leading to higher prices and reduced availability of those goods and services. This can be caused by various factors such as supply chain disruptions, natural disasters, or regulatory barriers. In contrast to demand-side issues, which arise from changes in consumer preferences or purchasing power, supply-side issues primarily affect the producers and suppliers of goods and services. Addressing supply-side issues often requires policy interventions aimed at increasing the availability and affordability of key inputs such as labor, raw materials, or energy. But let's also look into the differences and similarities a bit more before we address precisely what Rogoff thinks. So, the cause of inflation. In the 1970s, inflation was primarily caused by supply-side shocks such as the oil embargo, which led to high oil prices and a subsequent rise in the cost of goods and services. Today's inflation, on the other hand, is driven by a combination of factors, including strong demand and supply chain disruptions. And then policymakers responded to inflation with a combination of monetary and fiscal policies, which was sometimes inconsistent and ineffective. Today, policymakers have been more aggressive in using monetary and fiscal policies to address inflation, but there is still debate about the appropriate course of action. Also, in the 1970s, unemployment was relatively high, which put downward pressure on wages and helped to contain inflation. Today, the labor market is much tighter, with low unemployment and labor shortages contributing to higher wages and inflation. Another reason is today's economy is much more globalized than it was in the 1970s, with complex supply chains and interconnected financial systems. This makes it more difficult to control inflation and presents new challenges for policymakers. And the last reason we'll give is because of technology. Technology has changed the way goods and services are produced and consumed, with innovations such as e-commerce and automation having a significant impact on prices and inflation, and this was not a factor in the 1970s. So Rogoff does argue that the current inflation is different from the inflation of the 1970s because it is mainly driven by supply chain disruptions caused by the pandemic as opposed to excessive demand. However, he warns that if the supply chain issues persist and are not resolved soon, they could lead to more permanent price increases and wage hikes that would fuel inflation and could result in a stagflationary environment. In his opinion, the supply chain disruptions are not temporary but could persist for a longer time and continue to be a drag on the economy. For example, he cites the shortage of computer chips, which are essential components in many industries, and the impact they have had on manufacturing and production. Rogoff's prediction of stagflation is based on his belief that the current situation is different from previous inflationary periods, but that the risks to the economy are significant and could have long-term effects. He believes that while banks have tools to combat inflation, such as raising interest rates, the situation may be more challenging to manage given the unique circumstances of the pandemic. So to summarize, Rogoff believes that there are several factors that could contribute to stagflation, including the persistent supply-side issues such as labor shortages, supply chain disruptions, and rising input prices, which could cause prices to continue to rise even as economic growth slows down. In addition, he notes that the unprecedented levels of monetary and fiscal stimulus used to combat the COVID-19 pandemic have added to inflationary pressures. But what do the skeptics say? Well, some argue that Rogoff's predictions may not take into account the potential for technological advancements and increased productivity to offset inflationary pressures. For example, advances in automation and artificial intelligence may lead to greater efficiency in production, which could help keep prices stable even as demands increase. Similarly, improvements in renewable energy technologies may help reduce costs and mitigate inflationary pressures in the energy sector. Moreover, some skeptics argue that Rogoff's prediction is based on a flawed assumption that the current inflation is driven by monetary policies and not other factors such as supply chain disruptions, rising commodity prices, and labor shortages. According to these skeptics, Rogoff's analysis fails to take into account the complex and dynamic nature of the global economy, which makes it difficult to predict inflation based on simple economic models. Some skeptics argue that Rogoff's track record on predictions is not very strong. For example, in 2011 he predicted that interest rates would rise sharply, but they ended up staying low for many years. This has led some to question whether his current prediction about inflation will turn out to be accurate. Others have pointed out that there are many factors that can affect inflation, and it can be difficult to predict how they will all interact. For example, while Rogoff has focused on the impact of supply chain disruptions and labor shortages, there are many other factors that could affect inflation, such as changes in government spending or shifts in consumer behavior. So there you have it, Rogoff's prediction and what others think about his line of thinking. But what do you think? Are we headed towards yet another stagflation or not? Let us know in the comments below. As for now, that's all from us at Profit Protection. If you want to learn more about the outlook for stocks and the financial market, perhaps check out another video of ours in which Peter Zeihan speaks about the implications of the SVB collapse for the rest of the market. Also, make sure to subscribe for more videos from us, and don't forget to like the video to show your support. But until next time, I'll be seeing you.